Hi, I'm Brian.
And I'm Tom.
We are the Dividend Dudes.
We are the Dividend Dudes. So we've been covering all sorts of stuff, and it's that time again.
It is that time.
Except that's in the next video. We're going to buy our stock next video, but the time is to analyze the stock and figure out what we're going to be buying.
And in this one, we're going to go through our process with you. Not detailed yet, but our base process on how we pick stocks that we put in our portfolios so that you can follow along and do the same.
Yep. At least that's what we think we're going to do. Up until now, the kind of the way we've done it is somewhat random. There is a reason behind that. There is actually a method to the madness. So when we pull up a bunch of random companies and we give you all these financial metrics, we say PE ratio, earnings per share, all the stuff that comes into that, and it seems like we're picking random stocks. Well, what is the point of the financial metrics? Well, one, at first, our portfolio was not diversified.
We had 0 stocks, so yeah.
I mean,
we needed stocks to put into it, so where do you go? Go to a screener and pick dividend stocks between 5 and 10%, and you get 300 stocks. I go through them all and pick out some that look interesting, get about 15 or 17 of them. And then
we find one.
We go through the metrics.
Yep.
But it's all pretty much random as to what I thought looked shiny.
The shiny thing distracted Brian. It's not as random as you would think. The reason why we sometimes pick random ones, and we'll show you in the next video, we'll show you some of the spreadsheet. We'll put together the stuff that was randomized. Brian's got stuff on his list. I've got stuff on there. We actually had some viewers that sent me text messages and they said, hey, check out these two.
Don't send text messages.
Yes.
Put it in the comments. You are all free to put any of your suggestions in the comments. We look at them and we'll put them in our next stock picks to see if they're actually good or not, according to our metrics.
Well, we look at them, except for the ones that, are mad at us for whatever reason, which thankfully we don't really get any comments yet, so it's not that big of a deal.
Why would anybody be mad at us?
I don't know, maybe my yellow shirt that I'm not wearing today, I'll wear it next time.
I'll make that shirt yellow. We'll fix it in post.
We'll fix it in post. Everything gets fixed in post. -1 earnings per share, +1. Just magically it shows up.
Yeah, I could do that.
So moving forward, we're going to be focusing on industries. Why are we doing this all of a sudden? Well, back to what we talked about when we select our stocks. We were going to time the video and the timer stopped, so we're just going to look at the clock and make sure we stay close, under 15 minutes.
I'll cut that out.
We'll cut all that out.
Sorry, I ruined your flow.
You ruined my flow.
Keep going.
He's always attacking my flow. Back to it. So, moving forward, we're going to be focusing on a specific industry once per month. The reason why we're starting to focus on specific industries is because we actually have some diversification.
Exactly.
We actually have some stocks. We've got AT&T, that's kind of a telecom stock. We've got a Merck, which is pharmaceuticals. We've got General Dynamics, defense contractor, and Coca-Cola, that's consumer beverages.
Yeah, food.
So now we can start slowly picking our way into specific markets, and we can start analyzing companies within that market. Now, the good news about that, the previous video we covered price to earnings ratio. Price to earnings ratio is very useful within the industry. If you're trying to pick a different, 5 different industries, PE ratio is not going to really tell you much, because an energy sector is going to have a very different price to earnings ratio than, say a services industry or a tech industry. Tech industry typically has a very high price to earnings ratio. So we can actually start using some of the metrics that we talk about and are so fond of in these picks. The reason why we pick random companies at first when Brian was talking about this is because sometimes there's companies out there that we didn't even know existed. Like Rio is one of them. RIO is a stock that we're still very fascinated by. We haven't picked it yet, but that company, we wouldn't have even known to look for it unless we showed it up. It showed up on the stock screener.
Right. I know nothing about mining industries, so it's not one that usually comes up on any list that I ever pick in a screener. So this was an interesting exercise for me, just to find, there's other stuff out there that is actually decent, that I don't know about.
Right, and that's why we pick some of the random stuff. That's not going to go away. So moving forward, we're going to have the specific industry once per month that we're going to look at. We're going to analyze companies within that. Also, we're going to have a few picks that Brian wants to look at. We're going to have a few picks that I pick that I want to look at, and then hopefully we got some more suggestions from our viewers of which companies they want to look at. Ford came up, CIO came up, and PSEC came up. There's a few of them that they wanted us to look at, so we'll look at a few of those. And then we'll have a list of, I don't want to go really over 20.
Right.
It's really hard to actually dig into a company if you have a list of 100 companies.
Oh, and it's going to take hours to get through all that. So
Yeah.
looking at balance sheets and cash flow statements for each individual company would be maddening.
We could do that, but we need more subscribers.
We need more money.
Yeah, we need monetization to actually help us do that. We do this on our own for a personal portfolio, but I mean, when we're doing it, we're only analyzing 5 or 6 companies at one time. This Dividend Dude portfolio will do at most maybe 20. So that'll get you a good idea of what we're doing. We're going to go through the methodology. It's like
Methodology? Mythology.
Yeah, I can't say it.
Methodology.
We have a
The
method.
myth of our methodology.
Yes. We have a method. So we're going to pick the method for you guys to see. And from there, once a month, we're just going to keep going down the same path that we're at. Dividend portfolio, if it's behind the laptop or somewhere else on the screen, we're up to about $1.04 per week. That's great. But this next purchase will probably bring us, closer to $1.25, maybe $1.50, depending upon what we pick. So you're welcome to send us any recommendations you'd like us to analyze. We're going to make sure they pass the smell test. I mean, we're not interested in companies that are negative earnings, at least not at the fourth, right? Unless they're curing cancer. They have to do something valuable. So, but beyond that, please send us stocks that, you think are going to be a good company that maybe we should look at, and we'll be happy to look at them. We'll add them to the list. Can't add, again, 100 of them, but we can pick out a few from the stuff that people are sending us. And then we'll certainly tell you what they did, how they performed. And
if you, we get a lot of comments and a lot of people, we get 100 different stocks that they want us to evaluate, then what we'll probably do is pick the 5 or 6 best out of that 100, and then we can talk about them.
Yep, and that might, who knows? I mean, maybe somebody will come up with something that blindsides us, and it was a really good buy, so we end up putting it into the portfolio. That's what Rio did for us. I keep saying Rio, it's RIO. It's not really Rio.
Yeah,
it's like Rio brand.
Rio.
But it's what Rio did for us, last month. So. On the passes that we do for the companies, there's a smell test. So a couple of very easy things to think about. Are they making money? They have positive or negative earnings per share, price earnings ratio. We kind of pick out the ones that are not. Companies that are super tiny.
Yeah, small market caps.
Yeah, sometimes they can pay dividends, but if it's under $100 million company, those dividends can go away so very quickly. At that size, most of those size companies don't have a whole big subscriber base of thousands and thousands of customers. Even my own company has a couple of very large customers to us that if we lost a few of them, it would hurt us. So if you're on a $100 million company, we typically will look at them, but if they're really profitable, but they tend to be a little bit more risky, a little bit more volatile, so we try not to have those. Other parts of the smell test are, if they have assets that are doing this,
dwindling,
and their liabilities keep doing this. So we try to avoid those. So we do, the first pass is kind of let's put them all together. The second pass is let's see which ones are actually profitable.
Right.
And then from there we iron it down a little bit further and actually dig into the companies themselves. This is where we actually look at the balance sheets. We look at the cash flow statements, we look at their assets, we look at maybe upcoming business sales. We don't really get too much into the news or what the company's doing at this pass. And then on the third pass, this is Brian, I asked you to look at RIO because we didn't understand it. The third pass that we do is to figure out what are they doing.
Right.
What is this company actually doing? Are they developing the 5G network? Do they win a big contract that makes us look good? Because it's good to know those things.
And that's when I will go into the news and different sources that I consider to be reliable to figure out exactly what they're doing and how they're doing it.
Yep. And then we have to pick one.
Just one.
Just one.
Because we only have $400.
Maybe we'll get a pay raise someday, but it's only 400 now.
Someday we're going to pick a stock where that's not even going to be one stock.
Yes.
It's going to be a partial.
But if you're following along, like and subscribe, please. That helps us. But if you follow along, you go back in time and you go to the first stock we picked, AT&T, and you're doing the same thing that we're doing, you're getting $1 per week in dividends, just like we are. So that's great. So what that does is that helps pay off that first loan that you gave them. So don't spend that money. Wait until we get to the point where the dividends are starting to pay you back to the point where it overtakes the money that you're investing. That does take a few years, but it works.
You'll get there.
You'll get there. We've gotten there. You'll get there. Beyond that, we have some points on dividends because we like dividend dudes, and we just told everybody to recommend dividend-paying stocks to us.
That's what we do.
It is what we do. But if you recommend a company that pays a very large dividend, so if this company has lots of dividends that they pay, it really puts negative pressure on the price of the stock to also increase. So if you're talking 10, 12, 13, anything really kind of above 4 or 5%, that restricts now obviously there's exceptions. REITs are exceptions because they function legally. It's a different type of business. But most companies that are just a run-of-the-mill corporate entity, anything beyond 4 or 5% on a dividend check restricts the growth of the stock.
Right.
Because they're paying all those earnings out in dividends, they need some of that to grow their company. And if they're paying everything out in earnings, they can't really grow their company, which means your price is going to do this.
And also keep in mind why companies generally pay out dividends. It's because they have money above and beyond their operating budget that they don't know what to do with. They can't do anything with it to help grow the company. So they split that up and that becomes dividends for all of us.
Or that is one way. Or they can also just need additional financing. They could say, hey, we want to entice people to buy our company and say, let's issue a bigger dividend to pull more people in to invest in them so they can grow more. So there's actually a couple other things that you could add to that too, but those two things are generally what people are looking at. So lower dividend yields allow for higher trajectory, upward trajectory for the stocks, a little bit more leniency that way. It doesn't mean that that's what's going to happen. It just makes it easier for the company to invest its earnings into its own operation.
Right.
So there's a kind of a balancing act. So if you're looking at a company, and we had one on our list, was it Zim or something?
Oh, Zim, yeah.
Yeah, there was
like 30% or something.
So there was a company we looked at a few months ago that was they paid like a 38% dividend, and Brian and I both immediately were like, nope, because we looked at their assets and their assets just went way down.
Yeah.
I mean, the company had sold their assets, so you got a big dividend, but it's important to remember the companies you look at. This is not what they're doing tomorrow.
Right.
This is what they did yesterday. So this is, you're looking at their balance sheets, you're looking at stuff they did for month end, for last month. This is current to this date, maybe if you're getting them on their earnings date, but you're not catching a company of what it's doing in the future.
Correct.
So if you look at the one that says, hey, I'm paying a 38% dividend, and you had bought a company like that, well, you're not getting your 38% dividend because you weren't there for the sale of their asset. So you might jump in and everybody's like, okay, I got my dividend, they all jump out. So
right.
you have to be careful. So
now you're stuck holding the bag because now you're getting the 2% because it drops because of all their value went out of the company, and what you purchased the stock for also dropped. So you've doubly lost valuation.
You doubled it up. Yep. So this is why when we started the portfolio, and Brian talked about this, is that we're gonna get a little more risky later on.
Right.
But right now we want to protect our principal. We want to protect the assets that we have, and the stock market continues to be pretty volatile towards the downside right now.
And you've worked hard for that $400. So you want to make sure that works for you. Once you have it built up and you're getting thousands of dollars a month, then you can start using that money, which is the free money, to do the more riskier stuff. Like we've said many times.
Many times. Yeah, that's correct. So don't risk it too much if you're going to make a stock recommendation. And because I get this a lot, I had there's a couple companies I didn't mention in the viewers that had texted me messages about which ones I watched, because some of them were ridiculous dividends, and the moment I went into their their net income, it was going down.
Red.
It was like, so that's great. They paid 19%. Are they going to keep paying that?
Probably
So
not.
keep that in mind. Again, we would love recommendations. We'd love for you guys to give some of us input. So don't stop doing that.
Yeah.
But remember, if they pay a huge dividend, there's a risk to that. So they have to be able to afford to pay that dividend. Because example, we have AT&T as one of the companies that we own. What does AT&T do? They do telecom, they do cell phone services, they do internet, they do all of that.
Right.
In order for them to pay us their 5% or whatever, it hovers around 5%, whatever their dividend is, they have to take that out of the products and services that they sell, and the employees they pay, and the trucks that are on the road, and the warehouses, and all the facilities.
Yeah.
So if they're taking that out to pay you, that leaves them less money to run their business. So you have to be real careful. Now, diluted earnings per share and earnings per share cover some of that. We covered that in the past video. But again, if you're going to buy a company, you want to make sure that they can pay dividends moving forward, not what they did in the past. So I think that's all I had. I think next video we're going to talk a little bit about the actual stock picks, and we're going to make a purchase. We're going to increase our income.
Ooh.
Maybe we can get more horsey rides.
Maybe.
something, at the store that will hopefully not get us.
Bottle of water.
Bottle of water, 1 bottle per month. You won't drown or starve or drown. You can drown in a bottle of water.
Dehydrate.
Dehydrate. That's the word I'm looking for. So, but yeah, next video we're going to talk about the actual list. We'll have the spreadsheet up. You can take a look at how we narrowed it down to the one pick. We're going to buy the stock, and you're going to see what happens to our income as a result. I think we actually did get another dividend from AT&T too, so we'll post that as well, so you can see that we've gotten 2 dividend checks now. So like this, I can't see it. 2
Actual profits.
actual profits. We made actual profits.
We're still in the red, but we've made actual profits.
Well, we're in the red because
we bought a bunch of crap.
We bought a bunch of stuff. The camera, the lights,
We don't have a camera yet.
Our time.
Yeah.
So
we'll get there soon. At some point, our dividends are going to make up for that which we've bought, and then we'll be in the black.
And the troll online just said, yeah, when you're 95, fine. When we're 95 or 96.
96. That's a good even number.
96 and 1/4. But with all of that, thank you for watching. Again, if you like these, please subscribe and like, and we'll see you in the next video.
Make sure you comment, and if you don't have a stock to comment or a snide remark, just put an emoji in there, and that'll be fine. Just so we know you're watching.
We appreciate that. And again, thank you for watching, and we'll see you in the
always,
next video.
Happy investing.